Now we are entering into the section called the Trading Tools and Trading Systems. In this section we will cover a few basic trading tools and trading systems. By doing this, we will see how various trading tools and trading systems react to 4 phases of the market. One of the most basic tools is moving average. Here's a moving average. And here's the prices that are going up with their closes. There's 2 ways to trade moving average. You can look at the curve of the slope. If the curve of the slope is up, then the trend is up. When the curve of the slope turns down, then the trend is down. The other way of trading moving averages is, as long as the price is above the moving average, the trend is up. When the price closes below the moving average, then the trend is down, regardless of the slope. Well, we are at page 28. Later we will show you a computer test results of moving average stochastic system. Right now, let's explore different sizes of moving averages. We have a 10-day moving average, 20-day moving average, 40-day moving average, and 80-day moving average. Now, the 10-day moving average represents a very sharp trend or trend that is very strong. As soon as there's even a little correction, the market is going to go below the 10-day moving average. 20-day moving average gets caught on slightly bigger corrections, or when the market starts to go slightly sideways, and we get signals that says the trend has reversed, when in fact the trend is still up. Also, a 10-day and a 20-day moving average will often get caught in a sideways market. Let me illustrate what I mean by that. Here's a moving average. As the bars go up, as soon as there's a correction or a little bit ABC pattern, this is your A, this is your B, this is your C pattern. As soon as you have ABC pattern, a 10-day and a 20-day moving average will keep telling you that the trend is down, trend is up, trend is down, or the slope might start curving down and then back up. So a very short-term moving average is not very reliable to tell us what the long-term trend is doing. It's reliable as far as what the short-term trend is doing. And then here we have a 40-day moving average, which does not get caught in a small sideways market, but it will get caught in a big sideways market. So here we have a downtrend, uptrend, downtrend, uptrend, downtrend. Whereas an 80-day moving average gives us the longest perspective, and it does not get caught in these sideways market. And it tells us that the long-term trend is to the upside. Because we have different sizes of sideways markets, here's a big sideways market, here's a smaller sideways market, different moving averages will get caught in different sizes of price swings. So one moving average is not adequate. You should always use dual moving average. Here's an example of 10 and 20-day moving average getting caught in sideways market, whereas the 80-day moving average continued to indicate that the trend was up, and then finally the market closes below the 80-day moving average and trend reverses to the downside. Now during bigger choppy markets, even the 80-day moving average here, this one right here that's almost like a straight line, will get caught in the choppiness and give us false signals. That's why it is best to combine a short-term moving average and a long-term moving average. The 20-day moving average trades the short-term small corrections, or the 40-day moving average would trade small to mid-sized corrections. Even though this correction was fairly large, the 20-day moving average told us that the trend had reversed, whereas the 40-day moving average tells us that the trend is still up. And the 80-day tells us what the long-term trend is doing. Here's an illustration of if you were to use a moving average as a trend line and you bought it when it went above the moving average and you sold it when it went below the moving average. On this sideways market or choppy market, you can see there were 1, 2, 3, 4, 5 losses and only 1 winner and 1 neutral trade. So it's very critical you don't use moving average to indicate trend reversal. Here's an 80-day moving average. This is the same as the previous chart, page 32. This is page 33. You can see the 80-day moving average did not get caught in this choppy market saying the trend is up, trend is down, trend is up. But if the market goes sideways long enough, the 80-day moving average also gets caught. A popular way of trading is to use dual moving average crossover. When the slower moving average goes above the longer moving average, a buy signal is given. Faster moving average goes below the slower moving average, a sell signal is given. As you can see, short-term dual moving average crossover will get caught in choppy markets, and the markets are choppy 50% of the time or more. So short-term dual moving average, here's the test results. We use a 9-day and an 18-day moving average. MAV means moving average, and we went short when the 9-day moving average went below 18 days. Let me illustrate that. Here's the 18-day moving average, and here's the faster 19-day moving average that's going to move. And when the 9-day moving average went above 18 days, a long position was taken. When the 9-day went below the 18, a short position was taken, and that's how the trading results were achieved. So as you can see, because we're trading a short-term system, the frequency of moving averages crossing each other are very frequent, and therefore we have 1,504 trades. That is a lot of commissions to pay out, and the net result is $87,000 profit in 10 years trading these 10 markets. US means treasury bonds, Deutschmark, copper, gold, crude oil. This is soybean, wheat, cotton, coffee, cocoa. Now let's look at a 50 and a 30-day moving average. Because these moving averages are more stable, we don't get as frequent crossovers. And as a result, what happens is, here what we use is a 40 and an 80-day moving average was used. So what happens with an 80 and a 40-day moving average is, the 40-day moving average is very stable. It doesn't react to the market noise. And the 80-day moving average is even slower. So you don't get that many crossovers. And because of that, we reduced number of trades to 308 from 1,500, and our profits increased accordingly substantially. I think the previous dual moving average had $87,000 in profits. Here we have $130,000 in profit. Why? Because trading often does not make money. It pays out a lot of commission, but it does not make more money. Then we have triple moving average. What you do is you use a long-term moving average, a intermediate term moving average, and a short-term moving average. And when all three cross each other, then you have a trade. Let me explain that. Here's an 80-day moving average. Here's a slower 40-day moving average. And then finally, you have the faster 20-day moving average. Now, all three, the 20-day moving average has to be above the 80-day and 40-day, and the 40-day has to be above the 80-day moving average to give us a buy signal. So that's what happens here. Here the 20-day moving average goes above 80-day and 40-day moving average. We don't get a buy signal because the 40-day moving average is still below the 80-day moving average. As soon as the 40-day moving average is above the 80, we get a buy signal. So 40 is above 80, 20 is above 40, we get a buy signal right here. This is a buy signal using triple moving average. And an up arrow with a 1 means a buy signal. And a down arrow, a -1 means a sell signal, a 1 means a buy signal. So this system bought here, market went sideways and then sold here. That was a big losing trade, but let's look at the results. We further reduced our commission expense and slippage down to 264, and our profits went up slightly. Okay, now we're going to combine moving average with stochastics, but let's first look at stochastics. The way that stochastics work, for those of you who are not that familiar with it, because there are some beginner traders who are watching this videotape, Stochastics is an overbought, oversold indicator. The top line is 100%. The bottom line is 0%. And then you have slightly faster indicator that moves around faster. And when they cross each other, you get buy and sell signals. Right down here, the stochastics came all the way down, and then they crossed over. At the point of the crossover where this arrow is, we had a buy signal. This is page 40, by the way. And when the market went all the way to the other extreme, 80%, this is an overbought, oversold indicator. So when the stochastics is down at 20%, oversold. When it goes to the higher end of to the 80%, it is called overbought. And that's one way of using it. And when they cross over each other, you get a buy and sell signal. Here the market reached the 80% mark and then crossed over, gave us a sell signal here. Here the market went all the way down below 20, and then when it crossed over right here, we got a buy signal. Now, if you were to use this method just by itself, in other words, when market goes above 80% and crosses over, you sell. When market goes below 20%, it crosses over, you buy. You would have had 1, 2, 3, 4, 5 losing trades, and you would have had only 1, 2 winning trades. Again, my purpose here is not to scare you away from trading. The idea is I want to teach you what works and what doesn't work. And right now we're exploring the long-term perspective, the short-term perspective, and what a moving average can do for you, and what stochastics can do for you, and what they cannot do for you. Now, a lot of people try to trade against the trend by using stochastics or any other mean. And when you have a strong trend, you're going to get a lot of oversold sell signals. Here the market is above 80%, gives you a sell signal, another sell signal here. Market continues to go up, another sell signal, continues to go up, another sell signal, continues to go up, and finally it gives you a sell signal. Initially you're ahead, and then it comes back. You probably would be out at break even at this point. Again, you have 1, 2, 3, 4 losing trades and 1 break even trade. Point is, the correction waves are smaller, trend waves are bigger. Therefore, you should always trade with the trend and not against the trend. As you can see, the oversold, overbought indicators, whether it is RSI, stochastics, or any other overbought, oversold indicator by themselves, if you go against trend, would be very detrimental to your account size.